Okay, so first up, I want you guys to get your notepads and pens out, or your laptop notes, whatever you're using to take notes. We want to speak about something called support and resistance, okay? And write down these meanings. Support and resistance are simply areas in the market where where retail traders take trades off of, okay? So support, I want you guys to imagine a floor and a ceiling, okay? A floor and a ceiling. Support is the floor, resistance is the ceiling. Support is the floor, resistance is the ceiling, okay? Now imagine you have a bouncy ball, right? You have a bouncy ball and you hit the bouncy ball on the floor as hard as you can. What's gonna happen? It's gonna bounce on the wall and come back to the floor. Bounce on the wall, come back to the floor. Bounce on the wall, come back to the floor, right? Why? Because it's a bouncy ball. And you know, the momentum, gravity and science, all of that stuff doesn't facilitate for the ball to go through the wall, right? Once it hits a stage where, you know, it loses its energy and there's no momentum, what happens is the ball comes back down to touch the floor. Why? Because of gravity. So similar to this is the markets, right? Retail traders are the 95% of traders in the world who lose money in the markets, and we are not trying to become like them. So I'm going to show you guys what they look for in the market and why we don't look for the same things, okay? It will work for them a couple of times, but overall they won't have their edge, unless, to be honest, some retail traders do make money, okay, but they make money based off of them them compromising, or them not being greedy and taking money, taking profits, and they make money based off of their psychological method, not more so their technical method, if that makes sense. Okay, they will make money from the technical methods a couple of times, but it won't work every single time, which is similar to any strategy. It won't work every single time. However, we develop an edge, so we trade our edge, okay, which I'm going to get into. This is all sounding like jargon probably right now, but let's get into support and resistance, okay? So first up, we want to go for the monthly time frame. Anytime we are making an analysis, we always want to start from the monthly time frame, just to get an overview of where the price is at, what the price is doing, okay? So over here, this is the monthly time frame on Euro USD. The current price is at 1.07194. Okay, no problem. Can we identify any support and resistance levels? Okay, furthermore, let me go into my bar replay mode. I'm not sure if I've spoken about this already, but what bar replay mode is basically like mock test, okay? It's like a mock test where you can backtest the markets, you can revise the markets. You pay a little bit extra on TradingView to get the premium sort of upgraded subscription version, okay? And you can just simply play the market forward in real time, okay? And it just shows you like what the market has done previously, etc, etc. So support and resistance, okay? This is, let me come out of bar replay mode quickly. This is simply what support and resistance is. If I just use my trend line tool here, okay, this is support and resistance. This is how it looks. Okay, imagine now the price, when price might be doing this, okay, might be going up, down, okay, price comes to support, price moves like this, something like this, it goes to resistance. What happens? It reacts from resistance, so it will drop from resistance, okay, and eventually what? It will come back down to support, then the price will go up, back to resistance. It won't look exactly like this, but you get the gist, right? So it will look something like this, okay? Price will come down. As soon as it hits resistance, it will drop. As soon as it hits support, it will go up. As soon as it hits resistance, it will drop. That's what retail traders use. That's the method that retail traders use. So let's try and find something. Let's try and find support and resistance in the actual market right now. So they'll usually use a horizontal line. There's nothing wrong with using horizontal lines, rays, whatever it is. But let's try and identify where we can see support and resistance. Okay, so over here, boom, what do we have? We have support right here. Why? Because price has hit this level numerous times. Price has hit this level numerous times. What happens here? Okay, you guys know, I told you guys I'm gonna use my circle tool a lot. So what happened is price came, pretty much touched here. Yeah, okay, we put that there. Price touches level how many times? 1, 2, 3. Okay, multiple times. 1, 2, 3. When retail traders see price hitting support or resistance 3 times, that means the support or resistance is respected. That's what it means. In their eyes, it means it is respected. And what that simply means is it means it's a reliable point to trade from. That's what they think, okay? So in this situation, I'm going to show you guys why we do not trade support and resistance, and why we only trade, you know, once support, resistance, why we trade supply and demand, Wyckoff, accumulation, distribution. We're going to get into that in the later videos, but I just want to show you guys a prime example of why we don't trade support and resistance. Okay, so the reason why we don't trade support and resistance is because we won't have an accurate place to put our stop loss all the time, unless we are risking quite a lot. And what I mean by that is, to trade support and resistance, you would have to have like a stop loss of 30, 40 pips or so. Yeah, even more sometimes. Okay, to get an even less stop loss in terms of pips, you really have to be someone who's accurate, who's a veteran in the game, or you really understand what is going on the charts, right? And you know, there's the concept of 90% of traders lose 90% of the capital in the first 90 days of trading. Why? Because they're trading the wrong methods, they don't have the right psychology. So I'm going to show you guys a prime example. Even though we're on a monthly time frame, I'm just doing this to speed it up. I'm going to scale down into the lower time frames later on and show you guys. But this is just a prime example of why we don't trade support and resistance, and why it is that we trade when price moves away from support and resistance, when it comes back to create supply and demand zones, when it breaks and retests basically, okay? So let me show you guys this. We don't get in a trade when the trade is moving at support or resistance, okay? We get in the trade once the trade has broken structure. A break of structure simply means a level which was holding, okay, which was holding before, the level that was holding getting broken, the level that was holding getting broken. That's all a break of structure is. Now there's a break of structure on every time frame, okay? So depending on the time frame you're trading on, that is what you should consider a break of structure. Because a scalper, remember, the person who trades on the lower time frames, a scalper who trades on a 5-minute chart or a 1-minute chart, their break of structure will be on the 1-minute chart or the 5-minute chart. Whereas a person who trades on the H4, their break of structure is on the H4 time frame. Whereas people like us, okay, we consider the lower time frames for entries, but we consider the higher time frames for overall bias and analysis and hypothesis. We consider a break of structure on our execution time frame. What does that mean? On the time frame we are actually entering a trade off of. Okay, we're gonna get into that later. So right now, what I'm showing you guys why we don't trade support and resistance. Okay, so let's play this market. This is what retail traders are thinking. Okay, they're thinking, okay, the price has been respected 3 times, I'm going to buy this market. So what happens is they use their long tool. As soon as price touches support, they buy the market. They might have to take a profit of up to here. Okay, their stop loss will go where? Below the lows. Okay, so below the last week, that's where the stop loss will go. To be honest, that is a decent risk to reward ratio. So I'm thinking they're probably going to put their stop loss below these lows right here. Okay, I've seen people get 1-to-1s and 1-to-2s. Okay, so let's play this. What happens here? They're waiting for price to come up. What happens? Boom, their stop loss gets hit. They've lost money. This is why we do not trade support and resistance. And now guess what happens here? Now, because they've lost money because they were trying to buy the market, what happens is psychologically, emotionally, they're damaged. Why? They have a gambling mindset. Trading is not gambling. Trading is a legitimate career where price reaches certain points every single time. History repeats itself. All you have to do is know how to analyze data. If you're coming here to get rich quick, it is not for you. It is not going to work out. Okay, you can get rich quick, yes, but I'm showing you guys the ideology of retail traders right now. Over here, they've just lost money buying the market. So what do they do now? They see price dropping. What happens to them? They enter sells. So now they're selling the market. They're saying, okay, price is dropping, I'm going to drop with price. Okay, so what they're going to do is they're probably going to target, they won't even target this level here. They'll target the levels way lower. They'll target like, I don't know, let's say they'll target that low there, and their stop loss will go above the last week. So the stop loss will go right here. Let's see what happens now. Okay, price is dropping a bit, they're making a bit of money. What happens? Oh, price is showing sign of weakness, price is reversing. What happens? Let's see. Okay, now there's Wyckoff accumulation taking place. That was a spring. Last point of demand. Price push up from here now. Let's get that break. Change of character. Don't worry, I'm saying these terms on purpose. I'm not trying to confuse you guys because this is what's coming in the later lessons, okay? So now at this point now, they'll probably move their stop losses to break even. Let me pause. They probably moved their stop losses to break even, so a lot of them have been stopped out here. A lot of them have lost money right here. And now, the others are saying, what, you know what, let me move my stop loss a little bit lower. Let me risk a little bit less. So they might move their stop loss right at the price of. So now, I want you guys to write this down. Once support is broken, support now becomes resistance. And once resistance is broken, resistance now becomes support. Okay, so over here, this was support, previous support. What happened is price broke through the support, okay? It broke through the support, and now that support has become resistance. So now that a lot of these people move their stop loss to break even, when you move your stop loss to break even, what that basically means is you're not losing any money, okay? However, there's other traders who have moved their stop loss to, in this case, resistance. So let's wait and see what happens. Most likely gonna get stopped out. The stop loss is about to get hit. Okay, let's wait and see what's gonna happen here. Okay, there we have it. The stop losses got hit, they've just lost money. So this is why we do not trade support and resistance, because it's something that everybody can see happening. Well, us smart money concept traders, we can see it happening. And when somebody asks you what strategy are you learning, on here at Yarimi University, we are teaching smart money concepts, SMC. That's the strategy we teach, okay? We trade Wyckoff, accumulation, distribution, change of character, break of structure, inefficiencies, imbalances, and we're going to get into all of that later on. Okay, so now if we don't trade support and resistance, what are we looking for in this trade? Okay, although we're on a monthly time frame, what we want to do, guys, is we want to scale in. This entire, let me delete this now. This entire thing is a puzzle. This entire market is a puzzle, and we want to put together all the pieces of the puzzle for us to understand where we are going to enter the trade at the best possible price. So now we're on a monthly time frame. Okay, we are on the monthly time frame. We want to scale into the weekly time frame, the daily time frame, the 8-hour time frame, 4-hour time frame, 1-hour time frame, 30-minute time frame, 25-minute, 20-minute, 15-minute, 10-minute, and put together all of these. Put together all of this data to analyze where we are going to enter the market at the best possible price. Okay, now before we get into that, I want to show you guys what we do trade now. We trade order blocks. Smart money concepts, in our category of smart money concepts, there's loads of different things. There's loads of different methods that we put together as one. So we trade order blocks, we trade inefficiencies, we trade supply and demand, we trade Wyckoff accumulation and distribution, we trade change of character, we trade break of structure. So our strategy is to basically navigate around the market when the retail traders are out of the market. Okay, once liquidity has been taken. What is liquidity? The definition of liquidity is an area where a pool of money lies in the market, an area where a lot of the retail traders, if not all retail traders, where all retail traders are entering the market. That is an area of liquidity. Why? If it looks too easy, it's probably a retail area. Okay, so when people say buy at support, sell at resistance, that looks too easy. So it's only a matter of time before the institutions, the hedge funds, the banks and the corporations are going to come in with their large sums of money and wipe out those traders. Okay, because in order for there to be a buyer in the market, there has to be a seller, and in order for there to be a seller in the market, there has to be a buyer. So moves in the market cannot happen without liquidity. Okay, there needs to be enough liquidity in the market for a major move to happen. So that is why retail traders don't succeed in the market, because simply what they're doing, because they don't know how to trade, they're just giving away all of their money. Okay, so our aim trading smart money concepts is to trade like the pros, trade like the banks, etc. Right? Okay, there's no cons, trading like the pros. Hey, I'm on that. What he said that was it that Drake or Jack Harlow? I can't remember. But anyways, look. What are we looking for here? We are looking for supply and demand zones. What are supply and demand zones? Let me just draw this out very quickly, okay? Let me remove the drawings. Supply and demand zones simply look like this, okay? And guys, I want you guys to know each and every candle over here, they all have meanings, okay? These spikes that you see here, these are called wicks, okay? These are, and these rectangles that you see here, these are called candles, okay? Candles, okay? The candle is the body, the wick is the spike. Okay, the candle is the body, the wick is the spike. Whenever you see a big wick, that means there's not enough momentum to whatever side the candle is. For example, here, the price tried to come down, and what did it leave? It left this big spike, this big wick right here, right? Can you see? It left this big spike. What does that mean? There's not enough momentum to go down. Imagine something is tired, something is overexhausted, and it's telling you, hey, look, I can't do this anymore. I've been dropping all this time. I'm tired now. I need to relax. Okay, that is what this is basically telling you. Whenever there's a big wick, that means there's not enough momentum to the downside in this market. Why? Because the candle is bearish. So that's an indication that price wants to go up. Okay, and this is the body. Okay, that's the wick, and the body is what's in color. Okay, so each and every candle has a story. Okay, so for example, let me just put this out now. This is something that retail traders would follow. Okay, it's something that retail traders would follow. Okay, trading candlestick patterns. Okay, so each and every candle has a name. For example, a doji, 3 bullish soldiers, spinning top, hammer, double top, double bottom, bullish engulfing, bearish engulfing, pin bar, shooting star. Okay, they all have different names, right? And we don't really need to understand all of this. Why? Because we are trading smart money concepts. All of these guys you see on TikTok drawing flags and this and that, and then throwing money at the screen saying, oh yeah, buy now because this pattern is taking place. It's only a matter of time before they get stopped out of the market. Why? Because they're trading like retail traders, and we are trying to trade like the banks. Okay, so let me show you guys the only method, the only pattern that we're going to be using is bullish engulfings and bearish engulfings. Bullish engulfings is simply this, okay? Is where you have a bearish candle. The bearish candle in this case would look like this on our trading view charts. Okay, so this is how the bearish engulfing would look. The bullish engulfing, sorry, this is how the bullish engulfing would look, for example. Okay. So whenever we see this pattern take place in the market, every single time we see this pattern take place in the market, this is an indication that we want to get in the trade. This is an indication that we want to get in the trade. Are we going to get in the trade straight away? So for example, once we see this, what retail traders are taught is whenever you see a bullish engulfing, what a bullish engulfing simply means is when the previous candle is smaller than the candle that comes after it by a significant amount. The following candle has to engulf the previous candle. So if the previous candle is this big, the candle after it has to be at least this big. Okay, it has to engulf the size of the previous candle for it to be considered a bullish engulfing. Okay, so this is called a bullish engulfing. So retail traders, what they do here is they get into positions right here. They buy the market up, and they'll have a stop loss over here, or some of them will get away with it and they'll have a stop loss below there. Okay, but the risk to reward is very, very small, meaning what? They're comfortable risking 1 to make 2. That is not a good way to trade, guys. We want to get small, we want to have small risk and a very, very, very high reward. We want to aim for at least 1 to 5s, or 1 to 10s, or 1 to 3s, or what we ideally want to aim for is 1 to 20s, 1 to 30s, 1 to 50s. You know, those are the type of trades we want to aim for. So over here, how do we trade bullish engulfings? We simply get a box. Okay, let me just quickly get to my settings. Okay, no blue key levels. You can make your own templates as well of different boxes and colors and stuff. Okay, so how we trade bullish engulfings is simply this. Whenever we see this pattern take place in the market, all we are doing is drawing a box. We draw a box from the previous candle, not from the bullish candle. Okay, not from the bullish engulfing. We draw it from the previous candle's body from the lowest point to the highest point. Where's the lowest point? Here. Where's the highest point? Here. Of this candle. Okay, of the candle before it. So we draw it from the lowest point of the previous candle to the highest point of the previous candle. And now what we want to take place is we want the price to get away from the current price. We want the price to do something like this and then come all the way back down and touch our box. This is called a POI. Write this down. This is called a POI equals point of interest. POI equals point of interest. Write this down. POI equals point of interest. So you want to label out your POIs before you enter the market. You want to anticipate where the market is going to come. Why? Based off of supply and demand, order blocks, and all the other things we're about to teach you guys, okay? So this is what we wait for. We wait for price to push up and come back down to touch the box. That is called an order block. It's called an order block. So now, on the other hand, what do we have? We have the same thing, just in the bearish format. This is called a bearish engulfing. Whenever you see the price, coming here and forming a pattern like this is called a bearish engulfing. So similar to the bullish engulfing, all we wait for is price to come away from this, do something like this, come back down and touch our box. Once it touches our box, we sell the market, okay? And simply all we do is enter the market here, we sell the market. Our stop loss always goes below the highs, okay? The highest point of the order block whenever we are in sales, and our take profit, we're going to speak about take profit in a separate video, okay? But it will go a lot lower than that, okay? And our entry is here. And similar to the bullish order block that we spoke about, our entry is buys whenever the price touches here, and our stop loss goes below the lowest point, so below the box, and our take profit will go a lot higher than that, etc. Okay, and that is simply what we look for. So now we saw how retail traders got stopped out of this market. Now we want to look for points where price is going to react, and of course we are not position traders, so we're not going to trade on a monthly time frame. So now we are putting together all the pieces of the puzzle. We're looking for, are there any, so supply is found at the top of a market and demand is found at the bottom of a market, okay? So now we are at the top of a market, so what we're looking for? We're looking for points of supply. So now we're going to scale in, we're scaling in. Whenever you drop down to lower time frames, this is called scaling in. Write that down, okay? So now we've dropped down to the daily time frame and we're looking for points of supply. You see this little dotted dashed line right here? This is the current price, guys, okay? This is the current price. So I can see a supply level right now. So I want you guys to look at this chart now and pause, ask yourself, can you see any points of supply that you would enter the market from? Okay, pause, take some time to yourself, have a think, and then come back, okay? Okay, so I'm pretty sure you guys have paused and you were looking for points of supply, and I'm going to show you the point of supply that I like the most, that I found, okay, the cleanest. It was this point here, this point of supply. Why? This bearish engulfing order block. Why? It is simply following the rules, it's simply following the method, it's just following, it looks very clean, it hasn't been touched before. Write this down, whenever an order block hasn't been touched before, whenever price hasn't come into a specific order block yet, it is called unmitigated. It is called unmitigated, meaning what? The price has never touched here before. Whenever the price has touched an order block before and price moves away and price comes back to the same order block, we don't consider it. Why? Because it is mitigated. It is mitigated. We won't consider it to enter a trade again. We will only keep our trade open if price comes back to our order block and we're already in the trade. We won't look for another trade from a mitigated order block. Okay, so now this is the demand, this is the supply level that I found. So let's see what happened here. Oh my days, what happened, guys? You see, we drew out a clean level of supply, okay, and what happened here? Price poured in, price came into the box and dropped from the box. So already, even though we're on a daily time frame, if you just entered on, you know, at half of the box, or you entered, say for example here, you entered on the touch of the box, you would already be up 36 pips. Or if you enter somewhere here, you'd already be up how many pips? Well, the lowest point it went to was almost 200 pips, yeah? So you'd be up 200 pips. But now what are we going to do as smart money concept traders, okay? This is where we now look for Wyckoff. Write this down. We're going to talk about Wyckoff in the later videos. Do not worry, don't rush, guys. There's a reason why I'm going through this slowly, step by step. We are going to look for Wyckoff in these areas, okay? Whenever price, okay, we look for Wyckoff in these areas. Whenever price is high, whenever price is at the top, we look for Wyckoff. Whenever price is low, we look for Wyckoff, i.e. whenever price is at supply, we look for Wyckoff distribution. Whenever price is at a point of demand, we look for Wyckoff accumulation. We are going to get to that. There's going to be a whole There's going to be episodes about Wyckoff accumulation and distribution, so do not worry, guys, okay? So now from the daily time frame, we drop down. Let's drop down to the 4-hour time frame. What can we see? Okay, here we go. We see another point of supply. Where is it? From here. Why? Because this candle, this bearish candle, engulfed the candle previous to it. Okay, the candle that was previous to the bearish engulfing. Okay, so a candle was formed, and the candle following that, and the candle that followed after was a bearish engulfing that took out the previous candle. It's more confirmation. Why? Because it took out the candle that was previous to that, and the candle that was previous to that, and the candle that was previous to that, and the candle that was previous to that. So it engulfed 4 candles, which is absolute confirmation. So what happens is price moved away, price came back, it touched our box. So what happens when price touches our box? We enter a sell position. So we sell the market from here. Now once we sell the market from here, our aim is to identify a take profit level. So say for example in this case, our take profit is going to be somewhere over here. Okay, somewhere over here. Don't worry guys, we're going to talk about take profit properly in the next video, and our risk to reward definitely won't be this much. So now we're on a 4-hour time frame. What we want to do is we want to scale in. Okay, why are we scaling in? Because we don't like 1 to 2 risk to reward trades. So we want to find the smallest stop loss ever. Okay, we want to find the smallest possible stop loss. So let's scale into the 1-hour time frame. Can we see anything on the 1-hour time frame? Absolutely, yes we can. What can we see? We can see another point of refined supply. Refined supply, where this candle, okay, till here. This is another order block. It's another order block. Why? Price came away, price came back in. So now our risk is no longer 76 pips. Okay, our risk right now is how many pips? Okay, 34 pips. I'm still not pleased with that. Why? Because we trade smart money concepts. Okay, so what are we doing now? We are going to scale in again. We want to scale in again, and we want to find a more refined area of supply. Okay, so what have we found here? Okay, we can see something coming. Ooh. Sorry, just messed up. It wouldn't give me that much data. Okay, so look. Anyways, so look, guys. The point is this, right? The point is this. So I found this area of supply right here. Okay, so I'm entering here. My stop loss goes above, and now for my take, although I wouldn't enter this big of a stop loss, this is just from the higher time frame analysis, which is just to make an example. Okay, so we want to look to take profits at these areas, these lows right here where price previously stopped. Why? Because history repeats itself. Although we wouldn't really consider taking 1 to 3 risk to reward trades, I'm just doing it for this example. Okay, and our take profit, we're gonna speak about take profit in another video. But this is just to show you guys an example of why we trade supply and demand, order blocks, Wyckoff, etc, etc. Okay, so boom, what happens is price hits our take profit, we've just made money. Okay, so what happens is we waited for retail traders to exit the market, to get stopped out of the market, and basically all we're doing is we enter trades when the traffic is over. Okay, we don't enter trades at rush hour where everybody's rushing to enter trades and make money. We wait and we wait and we wait, and we're patient. We wait for retail traders to get stopped out of the market, and then we enter with the banks. That's all our aim is. Okay, we aim to enter the trade with the banks to the best of our ability. Okay, to the best of our ability, and that's all we're doing. We are going to lose trades sometimes. That's normal. It's trading, but our aim is to trade like the banks. Prime example in this case, we just profited from that trade. Okay, and look where price went to. Okay, we could have taken profit even lower, but we targeted these first lows. Okay, but look where price stopped. Where the price stopped? Price stopped at a level of demand. Why? It's a bullish engulfing. Remember, I've just taught you guys one pattern now, and from this one pattern you can see that the market respects this pattern time and time and time again. So from here we are now expecting a reaction for the price to go up. Why? It is at a level of demand. Liquidity was taken here. Don't worry about this jargon, we're going to speak about it later on, but I'm just showing you guys an example. Why? Boom, price goes up as soon as it touches the level of demand. And that is why we don't trade support and resistance. We trade supply and demand, we trade order blocks, we trade Wyckoff accumulation, distribution, change of character, break of structure, smart money concepts, and a whole load of other stuff like inefficiencies, imbalances. So don't worry guys, okay? I'm going to show you the source, the secret sauce to how you can make consistent profits in this market. So I hope you guys enjoyed this lesson, and I'll see you guys in the next lesson.